Hey there, I am here at the magnificent Mohonk Mountain House for my friend Twyla's birthday. Over the last year, a lot of advisors have told me that they have a large chunk of assets in money market funds because they felt nervous about both equities and fixed income, and peeling around 5% annually with no risk, even with the obvious limit to the upside, seemed like a good call. Money market assets have gone nuts, adding about $1 trillion in the last year. It makes sense. They feel like a sure bet, but there will likely be an opportunity cost on the other side. Advisors understand that this won't last forever, yet most don't have a strategy for what to go into when dropping rates make money markets less appealing. Let's look at the last year. Since the start of June in 2023, money markets did a little better than high yield, which came in at just under 4%. And indeed, you made a good call when compared to aggregate bonds, which lost just over 2%. However, the S&P 500 has returned around 27%. So you made less than a fifth of the S&P. The tricky part is, now what? People like to believe that they're going to get a clear sign of when to make a move because in retrospect, it always seems so obvious. But the reality is that this is why we spend so much of our time honing quantitative metrics. It's hard, and you may prefer to be running your business instead of maniacally watching indicators for when to shift and into what. Another issue is failing to participate in market gains for an extended period can provoke investor distress. While many feel like markets are overly concentrated and we may be near a top, we could easily have a repeat of last year's booming market this year, and that could be the breaking point. For investors, position for optimism and growth, but address contingencies. Money markets have always been a bad long-term plan, and they still are. Thanks for joining me. Take care. Bye.